Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Michael back on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Michael's picture saying, looking for the downloads.
Patrick, for this week's Trade of the Week, you're zeroing in on Michael's idea of a structural bid under the U.S. dollar. How are you thinking about positioning around the greenback here, especially with the euro having been in such a strong uptrend?
Well, Eric, coming out of Michael Every's framework, the dollar story isn't just about rate differentials. It's about structural capital flows. If the U.S. policy and financial architecture are pulling global savings into dollar assets, then the dollar may have more embedded support than the market appreciates. And on top of that, any global risk-off impulse can quickly add a safe haven bid, reinforcing the broader thesis. The cleanest way to express that is through the euro. I'm looking at shorting the June 15th, 2026 6E Euro futures contract, currently trading around 118.50. The challenge, though, is that the primary trend has been a strong euro. And so there's a real risk of being early. And in currencies, being early can mean enduring a squeeze before the macro narrative turns. So instead of running a naked short futures position, I want to dampen the early entry risk with a short-dated hedge. Here's the structure. Short that June 2026 Euro futures at 118.50. Against that, buy the April 3rd, 2026 120 by 122 bull call spread. The spread costs spot 0030 or about $375 per contract. It's 200 pips wide, meaning it can be worth up to $2,500 for every contract for a maximum payoff of roughly $2,125. What this does is straightforward. If the euro squeezes high over the next 44 days, that call spread offsets much of the mark-to-market pain. And alternatively, if the dollar thesis plays out immediately and the euro rolls over, the hedge simply expires for a $375 loss as a cost of insurance. So the intent is simple: express a structural bullish dollar view via the euro futures, but use a short-dated call spread to manage the timing risk and avoid getting shaken out if you were early.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
Eric, let's talk about these markets. What's going on here?
Patrick, the more I think about this equity market, the more I think about the midterm elections. Let's face it, whether you love President Trump or hate him, nobody could possibly argue with the fact that his policy actions have been bolder than they were in his first term in office, and they've infuriated Democrats more than ever before. So the midterms represent a massive fork in the road. If Democrats take both the House and the Senate, there could be no question that the final 2 years of Trump's term will be punctuated by more impeachments and lawfare. If Republicans somehow pull off a miracle and keep control over both chambers of Congress, well, then there's little doubt that Trump will be even bolder in carrying out the economic statecraft policies that Michael Every spoke of in the feature interview. Markets hate uncertainty, and it's hard to imagine anything other than diminishing certainty through the midterm elections. So I think that presents a massive headwind for equity markets. It's not necessarily impossible to overcome that headwind, but all it would take to bring on a big downside risk event in markets is just a strong hint that Republicans are losing ground in the run-up to the election. I don't have a strong view as to when or how that would come about, but my thinking is that downside risk will continue to increase as the time towards the November elections decreases. So I think from now to the election, the left tails are fatter than the right tails.
All right, Eric, let's talk about the S&P 500 and the key levels. We're trading below the 50-day moving average, and we're just above the 6,800 tripwire, where a lot of systematic trading will accelerate on the downside. So we're at a very sensitive moment. We're going to find out what happens next. And the interesting part here is that we've seen that the Mag 7s continue to be very weak. This is a thesis that I've had, which is essentially the market really simply would not be able to rally unless the Mag 7s join the party. They're just simply too big and too important. And what it really comes down to is next week, before we do our next episode, we're going to get the release of NVIDIA's earnings. On page 5, I have that semiconductor ETF, the SMH chart. And what you can observe here is that it's been in a very strong bull trend, but it's been in that bull trend without NVIDIA's participation. It is important to note that NVIDIA makes up 20% of this index. And so with NVIDIA having simply not participated up until this level, it's going to be very important what happens to it on its earnings. If it breaks to lower lows and starts some sort of sell-off like many other Mag 7s have, it will break the semiconductor index and probably open up the floodgate on the downside. Now, I'm not saying that that's what I'm predicting to happen, but I do believe NVIDIA's earnings are that important. And if the bulls want to keep things together, then it's going to really be on the shoulders of NVIDIA to beat and have a positive upside move on its reaction. All right, Eric, let's talk about that US dollar index. What are your thoughts here?
Patrick, my long-term outlook is still bearish, but we're in a consolidation pattern here, and the next leg could go either direction depending on headlines. We've got, imminent threats that there may be a major military strike on Iran coming this weekend. Okay, obviously, U.S. dollar usually responds to the upside in an event like that. There's probably a lot of that is already built in. That means if nothing happens, we have another taco event, then perhaps it sells off next week. I don't want to be taking a directional bet either way going into the weekend. Longer term, structurally, I'm still bearish.
Well, Eric, we just talked about the U.S. dollar and the trade of the week. Overall, the primary trend of the U.S. dollar has been down. It has broken key previous lows, but it never has followed through on the downside, and dips are being bought. I view this 97 to 98 level to be a neutral zone, a place where the dollar is consolidating, and we're going to see whether or not the U.S. dollar can make a bullish breakout above 98 in the week to come. That's going to be a very critical technical level to show a pivot in the trend, which is currently to the downside. All right, Eric, let's talk about crude oil.
Patrick, crude oil is rallying on rumors of the imminent Iran strike coming this weekend, or maybe coming this weekend. We know that President Trump's style is very much to use these big threats as bluff and intimidation tactics. But we also know that striking Iran in specific is a threat that he's proven himself willing to actually carry out. I think this weekend is going to be the tell for the next leg in crude. Obviously, a military strike over the weekend will spike the market higher on Sunday's open. But some of that is already priced in. On the other hand, if there's no action over the weekend, well, that would suggest this has all been a big intimidation or bluff tactic, and I think that might lead to a significant sell-off next week. Bottom line, though, we don't know what's going to happen until it happens, and I think it will be news that sets the next leg for this market.
So, Eric, we've been talking about the fact that crude oil has been so resilient all year. Every bad news event that has occurred has caused one day of selling, and the buy-on-dip traders would very quickly come back in and buy the dip. We've now spent over a month above the 50-day moving average, higher highs and higher lows, each pullback being held. This is structurally an accumulated market. Technically, it actually looks very bullish. What will be interesting to see is whether or not they will make a breakout stick here where we can potentially see a return back to last summer's highs up in the low 70s. Now, Eric, what are your thoughts here on gold?
Well, Patrick, we're still in a great big consolidation pattern here after that major correction that we saw on the Warsh nomination, or I should say catalyzed by the Warsh nomination. I think the real cause of it was the fact that the market was overextended. We took a dip down to test the 38.2% fib retracement level at 4882, 4882 on the recent correction into post-holiday thin liquidity. Then we briefly rallied back up above the 50% fib level at 502. 50.24 in the Wednesday to Thursday overnight session. Now, just a couple hours before the New York Open, we're trading just below that 50% level. And, we'll see what happens as we get through Thursday into Friday. I think we're in a consolidation range here that's bounded by the 38.2% fib on the downside at 48.82 and an upside at the 61.8% fib, which hasn't really been meaningfully tested yet, at 51.66. That's 5166. Looking out beyond just this weekend and the upcoming news events, what we have not yet seen is a regular trading hours test of the 50-day moving average. I think that could be coming, particularly if there's no news from Iran over the weekend.
Well, my views on gold are actually very simple, and it's literally the same as what we talked about last week, which is we had an extraordinary bull run, a very violent correction, and now the remainder of the first quarter is most likely going to be simply a consolidation. And so it's very possible that the low near 4,500 that was put in a few weeks ago is likely going to be the low of the consolidation, but it wouldn't shock me here if we were rolling into March and April, just bouncing around within this trade range as gold kind of absorbs all of this volatility and just calms right down into this trade range. Eric, any thoughts here on uranium?
It looks like the swing low is probably in and the technical setup looks good for another leg higher. But broad market weakness or an unwind of the AI trade are the big downside risks in the room. Either of those events could bring another leg lower, and the weekly stochastics leave plenty of room for that outcome. But the slow stochastics on the daily chart are set up nicely for a swing trade to the upside. So that's my base case, barring a AI or broad market risk event. If those things don't happen, I think we're well poised here for another leg higher. If either of those things do happen, I think there's another leg lower.
Well, Eric, when I just look at this purely technically, the bull trend is very much intact. Dips are being bought. These retracements are holding moving averages and still holding retracement zones. So I want to give the bulls the benefit of the doubt, but there we are at some very important support lines that do need to hold here. And so let's see how it develops. Finally, I wanted to just touch on these charts on copper. So overall, copper put in its short-term high about the same time as a lot of the other metals did. And it's now in a mean reverting correction. It's trading right at its 50-day moving average, has done a retracement of its prior rise. So this is an area where we'll be watching to see whether copper can develop some key support lines.
Patrick, before we wrap up this week's episode, let's hit that 10-year Treasury note chart.
A very decisive breakdown in yields coming off of that 4.25 level all the way down to 4.05. We're at a situation where we're now a stone throw away from that 4% yield level. So bonds have been strengthening, yields have been weakening. It'll be interesting to see if this move becomes a big new trend.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trader of the Week chart book we just discussed here in the postgame, including a link to a number of articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.